CPI and rates and affordability, because that's the problem.
Yep.
And I want to show where our numbers are, and going in like I do every week, so nothing earth-shattering. But I want to show you what a crash looks like, and we can compare our numbers now and seeing, well, are we headed there? People tend to really gravitate. They're trying. A lot of the comments that I get, you can tell people are just looking for a number that's going to jump out and lower the cost of housing. And
Yep. No
and
doubt.
there isn't just one thing, and there isn't. It's we're going to be here a while, so it's going to be interesting. And this is, but here's how your week started. This is it's a purchase index, so it's showing that mortgage demand has collapsed. That we were up like 7.27, and there's just not very many people taking out a mortgage, right?
Correct. It has been slow. I mean, it's been, there's activity out there, but it's not jumping out of the woods.
Yeah, and having said that, and going to look at some stuff here, everybody's, oh, it's going to get really slow. It's already really slow.
Yeah.
So it's not like wow, sales are going to drop off, and then people are going to be desperate to sell their houses. That should be happening right now if that was simply the case. But there is a segment of buyers, first-time home buyers, that just can't get in. That's a fact. They're there, but there's also a segment of buyers, they're not having a problem. And where you can see on the bottom there, when you look at the numbers, I didn't think we'd get much above 2,400 contracts on a weekly basis, and we're up 2,600. It's not monumental, but I'll show how it's 700 homes less than what came on. So that puts downward pricing pressure. And I got some stuff from Realtor.com that I want to show, which is rare because I rarely agree with Realtor.com, but I do this time. Here is our inflation. It's stalling, but not rising, which is the median CPI and the trimmed mean CPI, and it's flat. So it's just not, they're trying to push it down, and it says I'm stuck here. So now they're focusing more on jobs, right?
Correct.
You had a much better day today.
Yeah, we've had a much better last 2 days. We've had 2 straight days of gains on rates. I mean, yesterday we saw bond market had a great day. It was up over 50 plus basis points on the 5.5% coupon. I mean, you see right here. I mean, right here, this green is good. These are prices. So as you can tell, we haven't had a couple of days like this since probably August.
Yeah.
We really just, if you pull back, this is their price. These are some wild movement swings here. Anytime you have a long bar or candlestick, that's a good or bad day. So we've had some good days. It seems like it's bottoming out here, and which is a positive sign. Rates have kind of stopped that bleeding. We were in the 7.25 range. Now we're looking at basically 6 and 7, 8, 7. We were looking at 7, 8, 7.25. So we've got a long way to go, but it's good to have a couple of positive days.
I just saw an agent on Facebook, and I sent it to you, and it was talking about there's 7, but this is historically the average. And I remember my first mortgage, and I just want to scream when I hear that.
Oh, I do too. I swear to
stop it.
Just stop it. You're comparing. It's like, yeah, I remember when cars were $500. I bought my first Model T, and it was only $500.
Yeah.
It's like, really stop comparing that. It's like you can't even do it. It's just dumb. It's just driving me nuts.
Trying to convince you, and then we hear this a lot in the industry, and I know you do too. Is that there's this chatter going on and say, well, buyers are now getting used to the higher rates.
No, they're not.
No, they're not, are they?
No, they're ticked. I mean, they're not getting used to them. They're waiting for that door to open up where they might, catch a glimpse of hope. Say maybe, they get into the low. We saw a lot of activity back. I think it was March, April, May of 22. think it was back. I kind of lose track of the years and the dates sometimes.
Oh man, I'm telling you.
I swear to God, I started talking about some stuff. I'm like, God, was that 20, 21, 22, 23, 24? But I mean, yeah, it's just,
Well, here's our sales per month, Pat, and I'm going to have to use my handy dandy magnifying glass to show you that dot. But notice how it's above last year and the year before. And I'm going to come back to this chart in a minute and do a comparison, because now I want to look at our active listings. So here's our active listings. They're climbing up, right?
yep.
And they started out the year at 20,000 week one. Here's week two, and this will get updated again on Monday morning, but it's going to go up. And I have been saying we're probably going to be up about here, 26,000, I think. Because if you're going between 400 and 700 a week, then it's, my math teacher would be proud. But let's look at what happened in 2007 for active listings. And there they are. Look at how high that is. 57,000. Okay. Now, but it's the difference between supply and demand that makes prices fall off the face of the earth. And it's also, what kind of loans were out there and how everything fell apart. And we won't beat that with a dead horse again, but I'm just trying to be a little visual here. So here's where we're at on listings now. Here's where we were in 2007. I'm going to go back to this chart and I'm going to add sales per month, 2007, almost identical.
Wow.
I mean, isn't that something?
Is that which goal? Is it the top line there?
The black line. Let me just compare 2025. Here's 2007. Our red dot is 2025.
Mm-hmm.
But our listings are going, our sales per month, I think, are going to kind of stay a little flat. I don't see them doing this. And when they did this and faced inventory going up, everything fell apart.
Yeah.
The crash didn't happen until 2008, but people that were watching the numbers and reading the tea leaves saw that coming. So these are the kind of indicators that you want to see to tell you, ooh, we got trouble.
Yeah,
and
I saw that. Well, just to jump in quick. I mean, I saw that in February, March of 2007. Things kept still rising, but you saw things kept rising, but then all of a sudden that chart just kind of went like this. It just kind of broke. And me and my buddy, I said this a couple times on our show, back in February, March of 2007, really things didn't hit the woodshed until about a year and a half later, a year later.
Yeah.
You just saw this cracking going on. And it's like, okay, this is getting even worse. But
take a look at our listing success rate right now. Again, here's the red dot here. So it's hanging at about 66%. And I'm going to get rid of 2022 and I'll just leave these 2 years in and I'm going to add 2007. Look at that listing success rate, 40%. That means people put their house on the market and it weren't going too good. So 2008, it didn't get any better at a listing success rate of 22.8%. Today we're at 65. So while it's slow out there and mortgage applications have dropped, we have not come anywhere close to the alarming numbers that should have us shaking in our boots right now. Now, here's the challenge. And I'm going to address this, and then we're going to go back to you here in a moment, and just because you got some Tina Tambour stuff you're going to share with us. This is the average list price per square foot. And, people had homes listed in November and December. They came into the new year and it didn't change much. We were sitting here. Let me pull up the right year here. But so 2024 is the lavender color right here, which is $364 a square foot. We're just about, no, $355. So we're just about started the year slightly higher than when we finished the year. So the optimism is still there for sellers. Sellers saying, I saw my neighbor sell their house for this. I know I can get this. And that is the sticking point right now, is that there is some, buyers are waiting. Sellers are trying, and it takes a while for them to get the memo.
Yeah, it takes them about at least 5 to 6, 7 months to get the memo, like we talked about earlier. I mean, how many times you hear that the seller, well, I'm selling my house, listing my house for 550, and you being the realtor, like, well, where are you getting that from? Well, my next door neighbor sold his house for 550 7 months ago.
Yeah, and mine's better.
Mine's better. Well, that was 6 months ago.
The listing success rate then was
they get that
77%,
stuck in their
now
head.
it's 66.
Huh?
I said the listing success rate then was 77. Now it's 67.
Yeah.
Those are the numbers that people need.
Those are real-time numbers.
And the realtors need to be upfront with sellers and say, let me share what's actually going on. And I remember we had that $1 million listing up in Scottsdale. And when I had the listing meeting with them, I said, now things have changed dramatically. Multiple offers are not on the table like what we used to see. And I said, and I showed the numbers. Here's what we're seeing. So, it's going to be a little harder now to move in this price point. And he wanted to, and we put it on, and he was so ticked off because he said, I figured that Sunday night I'd be looking at multiple offers. And I said, we talked about that.
Is that a mutual friend?
Yeah. And, just went right over his head. And I showed the numbers and showed where it was. So it's hard to get past that psyche when you get to that point.
I tell you what, you did him good because he finally listened to you. And then remember a couple months later, it's like, whoa.
It took, that's when my drinking problem started. So you had, you had some slides from Tina Tambor, the Cromford report that she shared on a presentation. They usually update them for me on there, but they haven't done that yet. So I haven't been able to pull it up.
Yeah.
But you shared some snapshots here. Tell me what we're looking at there. It's
I'm just going to call it Tina's tidbits for the day. And I'm not going to spend a lot of time. I'm just going to kind of give a quick wash overview of what, she kind of went over, and just to kind of throw it out there. She spends about an hour going over the Cromford report. It's once a month. And I don't know, she's for industry, people, real estate, mortgage people, but she said rates, bottom line is, I'm going to give you a couple of tidbits. She said rates are not coming to save us right now. Keep on doing what we're doing, rate buy downs. There are people that can afford these rates, but she said Powell, made a incredible statement saying, and this is pretty deep, that the activity in the housing sector has been weak.
Wow, that is deep.
Yeah. So, but she said since since the beginning of 22, we've seen about a 36% drop in housing sale activity. She talked about the spread on rates, the 30-year mortgage versus the 10-year treasury. Usually that spread is about 1.7. Right now it's at 2.28. And this is something that Barry Habib kind of goes back and forth to. I haven't listened to Barry. I got off that service. I've been using, Mortgage News Daily Live instead. I think it's cheaper, but Barry's good, but it was really, really pricey for what you're getting. So, there's about a half a point spread between the 10-year treasury and the 30-year. She said accepted contracts. She said right now, we're not in a buyer's market any longer like we were in November. Pretty close. She shows we're pretty close to a buyer's market. And she goes on to talk about, she gives us that chart that you have talked about or seen, the buyer market here, seller market. And she said, you can't use this market to really project price, but she did say too, she goes, we don't very often get into a true buyer's market, which I thought was it's really kind of a good point. We're never really, the only really buyer market we've had ever was really, in the last 50 years was 2010, 11, 12.
Yeah.
That was the true buyer's market. And she said, going back, here's another chart saying we're kind of in a balanced area right now. Like we've been kind of talking about. Just kind of a couple other charts. Talked about Open Door, how they were losing. They overbought, and they all that debacle there. So another chart. She said if you're in the outskirts of town, certainly there's been some activity there. She said, and I think too that this market, looking back on it, just kind of seeing these charts, there's such a elasticity of demand with rates, and demand of housing and rates. It's amazing the last 5, 6 years. When they start going down, people do come out of the woodwork. Talked about the median sales price. She said the sales measures don't tell us where we are. They tell us where we've already been. So she talked about the price appreciation, talking about the under 300,000 by price appreciation by price range, under 300,000. In December of 23 was 183. It's 185, 1%. But she said the biggest price appreciation, has been in this over $3 million mark, 7.5%. Went on to talk about the sales count, talking about how low it is. But she said certainly it really does feel like we are maybe at a bottom regarding the sales, kind of like what you talked about here just a couple of minutes ago, that we are probably at a bottom regarding the sales volume, that we will probably see an improvement. She talked about the luxury market being very strong still, probably tied to the crypto and the stock market. And went on to talk about closings over 3 million, was up 89% month to month from November to December. So luxury market's been very strong. Talked about the crypto, talked about the contract ratio that you kind of alluded to. It's amazing. You look at the cycles, how it's so predictable. Take out 2021. Obviously, this is a really abnormal time. And she said every year it bounces. Not sure how much we will go up, but we will go up after the first couple of weeks in January. And she said it's pretty chilly out there. We should have 8,000 to 9,000 escrow versus the 5,300, 5,347 that we have right now. And then she did talk about condos. What's causing the supply to rise? She said condos under 1,500 square feet. She went on to say, and this is kind of funny. This is not funny, but 0 to 1,000 square foot condos. Now, I don't know where you get a 0 square foot condo, so I don't know how that starts.
It's called a tent. Yeah.
I think that's a tent. Yeah. But, the supplies increased by 46%. Last year we had 1,018. This time it's 1,487. It's a 46% increase. The 1,000 to 1,500 square foot size condos, back last January, the count was for supply was about 2,586. Now it's 4,118, 59% increase. And she said this market's slowing, weakening in price. And she's alluded it basically to two things: insurance and HOA fees. She said condo owners are getting kind of a double whammy between HOA, HOA and insurance. They've gone up, and HOAs are seeing a rate increase across the board. And the problem is, she goes, if you get a vacancy and you're a condo owner, you get a vacancy, you're going to get hit even harder because you got to make the payment. So she kind of talked about that a little bit on the condo side. And she talked about rents dipping. We're seeing a dip off on average rents. So overall, it was, let me give, she showed up the heat index, contract ratio, the heat market. But really, when it comes down, talked about price reductions, about 2,600. But in summary, let me just throw this down to the summary here and just wrap it up here. Like I said, I just took a smattering of different snapshots she had. She said, overall, I thought this is kind of interesting. Market conditions. This is kind of her summary little clip. Average sales price per square foot. It's complicated. Median sales price. It's complicated. Sales over asking price, good for buyers. Seller percentage for concessions, good for buyers. So pretty much everything's kind of lining up toward the buyer side, as far as at least being able to, if you wanted to get in the market. So,
well, the interesting takeaway on that, and what you and I are seeing in the numbers too, is that what we're going to see going forward here right now is not a huge decline in the average sales price. We're going to see maybe in the 1%, 2% range, but what we're going to see is a huge monumental adjustment in the asking price. And that may not happen until April or May. Right now, people are optimistic. Put it on the market January. They're going to wait for February. They don't get any movement. They're going to, we see it all the time here on comments. I have my house list for 3 minutes and only 2 people came by. Well, you're too high.
Mm-hmm.
And I'm seeing a lot of pricing out there. It just makes you, I looked at one this morning. It was in Chandler. They bought it for $440,000 in 2022, trying to sell it now for $590. What in what universe did it go from 440 to 590 in 2 years? Yes, we went up 4% last year, went up probably 4% the year before that, but and I don't know where they get this feeling that 590 is the number. They started out at 599,999. So I don't know. I've got a quick question here from a great name, a guy named Ricky. He says, I've been working with a mortgage broker. I've heard of those guys.
Yeah.
But notice they shy away from FHA numbers and only present conventional, saying it makes more sense. Any thought on why this might be? I'm tier +1.
Yeah, if you got great credit, it does make sense. It does, it makes sense to basically look at conventional. The difference between, FHA has some leniency on credit scores. You don't get hit. One thing I've noticed, if you're under 740, you start getting into 686. I know this doesn't pertain to Ricky. Obviously, he said he's tier 1 plus, top tier probably. But you get in the 680, 690, 700 FICO score area. Your loan level pricing adjustments with conventional are, 1.5, 2 points, some cases. So you're buying a $300,000-$400,000 loan. That's an $8,000 difference there. And on top of it, if you're putting less than 20% down, let's say you're putting 5 or 10% down, your mortgage insurance is based on your credit score. So if you have a 680 or 690 credit score, you're going to get your monthly mortgage insurance premium is going to be pretty hefty. That's one way that you'd want to go into FHA. But FHA, other than that, if you got great credit, conventional would be the way to go. I priced out. I've got a gentleman I'm kind of working with right now that he's got credit, and I'm kind of debating on FHA versus conventional. Conventional right now, I'm looking at mid 7s with him, versus FHA would be mid 6s, but he's putting could be putting 20% down. So there's a mixture. He's not going to have the mortgage insurance with the conventional, but he'll have a lower rate with FHA. But it kind of washes this out. Lower mortgage insurance, but the higher rate in conventional. So you're kind of like, what do you do? But one of the biggest things is FHA's got the upfront mortgage insurance premium of 1.75. So on a let's say a $400,000 house, basically that my math isn't working today, but $7,000 that they put on top of your loan. So if you bought a $400,000 house, it'd be $407. So he's obviously giving you the right. That's why he's basically pushing it towards, not pushing, but just basically recommending conventional, because it does, on all equal scales, conventional would be the best way to go, even though the rate might be a little higher.
Hey, hope that helps, Ricky. We got I got some numbers here. Greater Phoenix employment. Look at that. Looks like your EKG there, Pat. So we said jobs have increased 26,500 compared to October, and increased 42,900 year over year. And so the unemployment rate's 3.5. And then it says, here's the current makeup of our industry. We used to not be very diverse, but now we got professional and business, government, leisure, and hospitality. That used to be our biggest employer, especially in the 90s. Healthcare is pretty much tied with professional and business services. And then manufacturing, 6% on and on. The job forecast, here's what they're saying. It's still going up to 2027. So here's national.
Tina went over that in her little thing. She talked about how, all the, jobs are definitely locating here.
Here's our national homeowner equity, because somebody was asking me a question the other day, a comment on there, and saying, well, what about people that have to sell? That when are people going to get start to panic? And I just said, well, what are they going to panic about? I don't see any panic selling. And this is why. National homeowner equity, Q2 24 year over year change, they're up 8%, 1.3 trillion. That's not anything to panic over. you can sell. And I was talking to a gentleman yesterday. He's seen some foreclosures, and he said, I saw a foreclosure on a house that when I looked at their purchase numbers, I thought that thing's got to be paid off. Why is he foreclosing? National negative equity down 15%. It's getting better. It's not getting worse. This is first quarter of 2024. So I thought that was interesting. But here's what Realtor.com came out and said, sellers beware. More homes on the market are going stale, which means they've been on the market too long. And, buyers look for that. Half of active listings had sat on the market for 70 days or longer, up from 61 a year earlier, and the longest median time on the market for December since 2019. Worse, the share of super stale listings have languished on the market for more than 180 days is also creeping up, hitting 24.3% last month. If you're on the market 100 days, you got to make a move. Says here, stale listings can raise red flags for buyers who may fear there's something wrong with the home. However, experts say the primary reason the listing's going stale is simply incorrect pricing. Like I showed you on that chart where the list pricings now, they're coming in too hot. Overpricing is the main culprit for listings becoming stale. Many sellers have expectations, and you just said this, about their home value that stem from buying craze of 2021 and 2022 when listings shot up across the country. In other words, well, my neighbor got that. Sellers can see what their neighbors got for their homes during that period and are reluctant to list for less. So they're really coming out and saying, your house is sitting. This is why.
So now, you're telling us that we're right.
Yeah, they are. They obviously they watch the show.
Yeah, they obviously do.
And our millions and millions of viewers, 32 million right now. Here's a survey of millennials desperate for affordable homes are willing to make some surprising concessions. Phoenix Business Journal here, and it was kind of interesting. It said, they're willing to buy a house that needs some work, and that's a big change.
Yeah.
So 57% of millennials said their desire to be a homeowner means they would be willing to purchase a home that smelled like cigarette smoke. 41% said they'd purchase a home that has asbestos in it.
Oh my God.
I remember a guy that wasn't going to close on a townhome I sold him because it had some asbestos in one of the small closets in the back bedroom. So the shift is here. 57% of millennials said their desire to be a homeowner means they would be willing to purchase. So I just read that. So some said they'd be willing to buy a house with pests in it, mice, spiders, leaky roof.
Well, it's kind of funny if you think about the cycle, the human psychology of the last couple of years that we've gone through. I mean, what we were talking about a couple of years ago on the show, since we're going on believe it or not, we're going on our 5th year.
Yeah,
it's crazy. I can't believe you put up with me that long. But how many times did we say a couple of years ago that people, and we've talked about this, how the younger generation they wanted a move-in ready house that they didn't need to do
anything. Want to do anything.
Yep. Don't want to do anything. And I think you're probably just based on what you just read. I think people are it takes a while for people to wake up.
Well, when they want that move-in ready house, and then they see a house that needs some work, they're sitting back and waiting for that work to be done so they can pay more for it.
Yeah,
and now
that's where we
shifting. So
that's what we talked about. Several months ago on the show, we had the renovation guy on. I mean, obviously, most mortgage brokers do not really. Renovation loans are not fun for mortgage people because you got to bring in contractors and things like that. But if you got fix and flippers, you can make that money on your side.
Yeah. Well, here's a comment that kind of ticks me off. 45% think their generation faces the greatest challenges in affording homes. I agree. With 33% pointing the finger at baby boomers as being the most responsible for the nation's affordable housing crisis.
Yeah, Rick.
Me. It's baby you boomers.
Boomer.
I hear that a lot.
Huh?
I hear that a lot. I mean, the blame game, you boomers. Well, okay, so it didn't have anything to do with fiscal monetary policy, COVID.
No, nothing.
International affairs. It's just you old guys.
You old
won't
guys
move. Um,
Well,
y-
there is some truth to that as far as because people are aging in place in their homes longer. You know, they're not
well,
moving.
just
They're not
because
moving.
of that, I'm staying here.
Yeah, I'm
You can
now
drive by really slowly, and I'm just gonna,
you're gonna be the stubborn old
get off
man. I'm
my
not moving
lawn.
anywhere.
Yeah, yeah, yeah. It's, we laugh about it, but this is a generation that got hit hard,
Yeah.
and
Oh, I
it's
know.
while you wait for it to sort out,
They got
it
pit
doesn't
slapped.
change. It's going to take a long time, and
Yeah.
it may, we may be in year one of a 5-year adjustment here, but
No,
it's
I talked, you heard, I mean, you look at COVID 2020, we're going into the fifth year of COVID. That's why I kind of talk about it. I mean, we're still reeling from the effects of it. So we're in a 5-year stretch here. It's gonna be a couple more years. Sitting back, looking at from the 10, 20, or 30,000 foot level, just talking about what's going on with rates and everything like that. I got to thinking that this next 3 to 6 months, like we have talked about here in the last couple of weeks, is that we don't really see a lot of change, but there's gonna be people trying to figure out what the new administration, what that's all going to kind of work out to. And I just don't see there's going to be a lot to digest in
yeah,
terms, especially with this Trump. People are trying to figure out where even the Federal Reserve, I think, is trying to figure out what the hell's going on.
yeah, yeah,
They've been off sides the last 3-4 years. They need to get control of their rates. Obviously, you've got Treasury rates. There's something going on because Treasury rates are going up. 10-year Treasury rates are going up, and the Feds are cutting. So there's a disconnect somewhere, and the market is just not acting right. The Fed's been screwing around here. If you think about it, we went from no cuts back a couple of years ago to actually was it end of 2023. Then we're going to we're going to have 5 or 6 cuts. Last year we had 3 cuts. Then a couple of weeks ago they're talking about the Fed the Fed's not going to cut at all now. So now
yeah.
all of a sudden, the last day, the chatter's kind of changed. Well, we might see, a couple of cuts. There was one Federal Reserve Governor Waller says he sees potential for multiple interest rate cuts in 2025. Where a couple of weeks ago they were talking about we're done cutting. So, and they're even talking about thinking about raising. So you get all this chatter back and forth. Christ, I mean, no wonder the market doesn't really know which way to go.
Yeah, yeah. And
I mean,
then you
I
have the
think,
debt, and we don't know what's going to happen with the debt.
yeah, you
You've
got
got all those 2-year and less notes that are going to roll over this year. That's a bigger challenge than CPI.
that I think is going to be. I think that's in the back room. They're talking about that. So you got 7 to 8, 9, 10 trillion that's rolling over short term here, like
Yeah,
7 trillion in 2025. I think they're talking more about that than they are the employment numbers. Quite frankly,
yes,
they're probably using the
yeah,
employment numbers as a smokescreen. Sometimes I sit by myself and I come up with these crazy ass theories. Oh, what if, but spending way too much time with myself. But I just think the next 3 to 6 months, you're not going to see anything that is going to, like you talked about earlier, that's going to say, all right, now's a great time to buy. We're just get stuck in this channel. I think we're going to see periods, 2 to 3 week periods where rates will soften up. If you're in the home buying process where you might be able to catch a little bit lower rate short term, but it's not going to be, I don't think, till the end of this year, middle to end of this year, that things are going to kind of maybe straighten out a little bit. And like I said, we're trying to figure out what's going on with this administration. Oh,
well, time to play 20 years says Zillow's the reason there are less affordable homes. Zillow made it easier for the average people to buy more regional than just local. I think
yeah,
Zillow was around in 2008. I mean, Zillow made it easier for a guy like me that was moving around the country, because I didn't have Zillow when I was moving around the country. So you had to meet with a realtor and see what was going on.
yeah,
It gave you more exposure to markets so that you could zero down on them. I mean, they did buyers a favor. Realtors hate them. We sold them our data. Well, whatever. They've got the highest volume real estate website ever. Embrace it. And so it gives you the idea, the capability of looking at a certain neighborhood and looking at houses without leaving your living room. So if you're moving to Cleveland, you can go in and take a look at that now. Whether or not that's a factor in raising house prices, it's just, look, money was cheap, supply was low. That's why house prices went up. And Renee wants to get this party going here. So we got
Well, it's kind of like I liken it to being a stockbroker. When I was a stockbroker from 87 to 97, you know, nobody really had access to stock quotes unless you called, the newspaper, or you called me, the stockbroker, to get a quote.
yeah.
Then I got out in 97 because I just saw the writing on the wall, or handwriting on the wall. Is just, but people were like, well, I looked it up. Let me look this up on my computer and see what's going on. Now it's kind of the same thing as trickling through the real estate market.
Yeah. Yeah.
So,
Well, this has been the talk of all week. Here's Timothy first. He goes, I bought 10 homes I wouldn't otherwise own. I'm an investor. All right. So I got Renee says, how will this fire issue affect the overall consumers? Will this change the way we see approvals and affordability? Well, the fire it's a local issue. I don't think it's going to affect anything here except for insurance.
yeah.
And now, having said that, we've got our own fire zones here as well. Heber, Obergard, Pine Top, Sholo, Payson, and Prescott and Flagstaff. All wherever there's pine trees, we have a fire problem. So I think it's going to be tough to watch, but nothing's going to be sorted out in California for many, many more months as this disaster continues to unfold.
Yeah, you're looking at years, really, quite frankly. And it's going to, who knows how that's going to have an effect. Obviously, it was 10 to 12,000 homes that were wiped out. It's going to certainly, it's going to take some time. Who knows how
it's
that's
going to be a long time before hammers start swinging out there. Now, what I think, and I talked on Dan's show the other day of the effects, and I said, once they get into construction mode out there and start rebuilding, I'll bet you we end up with a labor shortage here because they're all going to go over there and make more money in California.
Mm-hmm.
And they'll be pulling from Vegas and the Phoenix area to get skilled labor because they won't have enough out there to fuel that new construction. And that building those size of houses in that area is going to take a long time. And even if your house survived, what an awful neighborhood to have to go back and live in right now. Everything's all burned out next to you.
Yeah, my thoughts and prayers are out to them. It's just terrible what they're going through. I mean, terrible to see what North Carolina's going through back in October, November. The stuff that this country's gone through. And like I said, there's a lot to sort through.
And yet we're still moving 2,600 contracts every 7 days. So while it's really slow, I was looking at this. I still say in the industry, that they're going to be disappointed that Q1 is going to be as slow as it is. Everybody thought the rates were going to go down. Here we go. The short-term view of things. And I said, well, based on what I'm seeing, I don't think so. I think you're going to be disappointed. So I'm a little surprised today that we actually hit the 2,600 number. I thought we'd have a hard time getting over 2,400. So it's not a huge number. It's 200 houses in the scope of things, especially considering how many new listings we have out there. But I've been advising people, they go, well, if you were trying to get a bargain, better prices and more inventory, what do you think? When should we be digging? I said, well, you got to wait for January and February to wash out. You got to wait for the sellers to either lower their price or back off and say, I gave it the good old college try, I'm done. And that'll tell you where March is going to come in. And I think by the end of February, you're going to have more people willing to say, hey, shoot me an offer. I'm willing to talk.
Mm-hmm.
So get your ducks in a row with financing now. Get prepared. If your credit score is not where you want it to be, get it built up. Just be prepared that if you wanted to pull the trigger, you can go out there and start shopping for bargains. Right now, sellers are not very open to asking $550 and you swooping in at $485. We're not there yet.
No.
So Rick, you keep saying we need to divorce ourselves in 22, 23 pricing, but what baseline should we revert? I think it's when I look at 2023 and 23 baseline pricing on asking prices. Let's take a look at that for a second, because I'm looking at the average price per square foot, and here it is here.
Yeah,
Terry's
Terry.
back. All right.
Crushing it.
Crushing it. Yeah. We have to reban that word again.
Yeah, we got
We,
it's been awfully quiet the last year and a half. Nobody's been
yeah,
crushing.
we banned the word crushing it. Okay, so here's the average list price. So we finished out the year in 2022 at 331, and then last year 355, the year before that 364. The pattern is the same. I think I just don't see us jumping up to the 2024 prices right here that I'm seeing. So I can erase that. I don't see us going to 2022 just based on where we're starting now, right?
Yeah.
Because I think this number is going to come this way. And so it may mirror closer to, what's the purple line here? So to 20, I think it's going to be below both 23 and 24. So will we hit levels of 22? Russ, probably. I'm not sure if that clears it up. It clears mud, but I think, it's just so damn hard to tell.
Yeah.
It really is. And that's asking prices. And that's what has to change, because the actual closing price is, that's what people sold the house for. The asking price, that it's right now it's just out of whack. So
Yeah.
and YouTube. So Rick, Pat told me that you're crushing it. Don't believe a word he said there, Terry. So so I think Russ, it's hard to find a baseline on anything now. We've been up and down like my EKG for the past 4 or 5 years. I don't know what a baseline is. Tell me what you think. What do we look at and say, hey, this is normal?
Yeah.
Because I'm trying to go back and look at simple things like the Cromford Market Index and listing success rate, and it's just hard to find anything that drifts along that says this is normal, because every year we face different challenges, either facing it with a spike in interest rates or a dip in inventory. And so now we're sitting here looking and seeing more inventory start to show up and sales not following. So it's not going to look at all like last year, right?
Yeah.
So I don't know how it's going to shake out. The
Well,
best case scenario, just watch us every week and we'll tell you.
yeah, we'll tell you. Well, you got so many factors too. We're talking about, you add in the rates, you add in the lock-in effect that people are sitting at 3 or 4% on their home. They got equity. There's so many. We're in a totally new era. So, like I said, comparing it to 07, 08, 09, you just can't do it. It's dumb.
Trend wise, you could compare it to 1984 a little bit there. Keenan, haven't seen you for a while. How are you? Living in the real Wally world. Yeah.
No kidding.
So,
but I think it's going to be interesting to see, though. I mean, not to get political, but just talking about policy, I think it's going to be interesting to see what Trump, if his talk, he can walk the walk, talk the talk, talk the talk, walk the walk, whatever it is, as far as, based on what he said, if he could tap into, people have excoriated me for saying about, there was one guy a couple of weeks ago that said, oh, they're pumping more about oil. I mean, overall, I think if he can cut some of these restrictions, the regulations out, that is inflationary. That does add to the cost of business. If he can wipe a lot of these regulations, take one out or take 10 out for every one you add, I mean, stuff like that.
Well, they need to tackle
stuff like that's not going to have stuff like that's not going to have a 30-day effect on rates. So you're going to see this. It's going to be just like taking the air pressure out of a tire. You got to keep, really slow and slowly, it comes up. So I think that's why I think you're not going to see anything for the next 3 to 6 months. Maybe toward the end of this year, you start to see things implemented that might have some a decent effect on just the overall rate of inflation. People have to, I think I said this. Did I say this the other week? Fox Business News, some guy was talking about, energy. And I think I maybe said this, maybe I didn't. Tell me if I did or not, but I'm losing my memory here. But energy to go from point A to point B, energy costs have gone up, right? But it's not just point A to point B. It's from point B to C, C to D, E to F. And every time you get these incremental, increases so to go from point A to Z, all of a sudden you've got this 20, 30, 40% increase in a product. So if you could tap that all down across that supply chain, it certainly might have an effect on it.
Yeah, I was in the bread business for years, and I would sit in the financial meetings and stuff, and they're looking at, our costs and whether or not we're going to raise the price of a loaf of bread and everything, and seeing all the factors. And oil affects all your transportation, all your route trucks, and your packaging. Packaging is made from oil.
Yeah.
So whenever we had oil come up, you were getting hit pretty hard, and you would get hit really quick. But then you would have different commodities that would go up too. So you'd have storms that would wipe out, wheat fields in Kansas. So they always tried to use the commodity market to offset that. And then so you're right. It's just the price of oil worked its way into everything. And in real estate, it's our economy's been humming along pretty good here, but there's always something that can come out and make it, fall off the face of the earth, but it's not going to happen quickly. I mean, we could have a financial crisis show up that none of us have seen. But the latest numbers on the banks that came out this week said they're in really good shape.
Yeah.
Mortgage rates higher for longer. I hope those that may have bought into the marry the house, date the rate folks are okay. That did not age well. Those of you watching me, I never liked that. I didn't like it for a couple of reasons. One, I can't stand it when our industry wraps their arm around a slogan.
Yeah.
It
kind of crushing it.
Yeah, like crushing it,
Yeah.
And except Terry.
Terry.
Yeah, Terry's crushing it. So, but
I just think it's going to be, like you said, it's just going to be one of those, just a continuation of probably the last year and a half. I mean, nothing, stands out, but I like the fact that maybe some of these younger people are looking at, maybe some homes that aren't perfect. So
yeah, next week I may not be here. Let me see. Let me look at my calendar here. I'm gonna Yes, I won't be here. I will be in Cathedral City visiting my brother and sister-in-law. I'm gonna go over there and do that. So we will not be having a Thursday show next week. So I'm sure the world, as far as Arizona, will come to a complete standstill.
Yeah.
And you can take over, Pat.
I just don't feel, we're married at the hip, buddy. I don't feel going to an event by myself. I can't do it right now. Sorry.
Yeah. Well, I got 2 or 3 days to train you, but
yeah. All righty.
Well, thank you everybody for joining us. The millions and millions of viewers that once again we've had, and do me a favor and smash that like button. Even if you don't like it, smash the dislike button, because YouTube doesn't know the difference. But there's one guy out there, Pat, one guy. Every video gives me a thumbs down. Come on. Who are you? And why do you keep coming back if I've never put any content out that you like?
Yeah.
I think it just shows up to give me a thumbs down, and then that's it.
Yep. Oh, well.
So,
have a good.
Russ here, he had a couple of comments here. He goes, "That's my problem. No one seems to know what anything's worth anymore." Yeah.
Tell me about it.
Except Pat's motorcycle. So Russ says, I think new mortgage products, a 40-year mortgage using the Federal Home Loan Bank would have more immediate impact than deregulation or lower interest rates. As long as we don't do stupid stuff, I'm okay. As I see it, Trump's deportation policy might rattle the markets. I think everything's lined up for people to get rattled. There's no doubt in my mind.
Yeah.
And it can be anything. It's just going to rattle the market. So,
well, you know what? Once again, it's only headlines.
Crushing it, we're going to use the word rattled.
Rattled, yeah. I mean, nobody's going to come back. Everybody's waiting for something to drop, and it's just like, certainly to one last point, that the deportation thing, he said he wants to get the worst people out first. I don't think he's really zoomed in on people are working whatever they're doing. I mean, if you're working and maybe underneath the radar, yeah, maybe down the road, but right now they want to get the gangs and the drug dealers and stuff like that out. I think that's their number one goal, which I don't have a problem with that at all.
I don't either, and especially ones in Colorado. Here's Luck.
Hello.
Hello, gentlemen. So, well, look, we're going to cut out. Everybody have a fantastic weekend, and we will see you on the other side.
Yep. Take care, buddy. See you, buddy. See you, everyone.